I want to continue this market conversation. We're joined now by Keith Fitz-Gerald, Chief Investment Officer at Fitz-Gerald Group. Keith, great to see you. Oh my gosh, I can't talk today. It's the Friday. It's the weight of the weekend already hitting me. So I want to start with some of those inflation figures that we had out today. The Fed, of course, repeating again this week that inflation is going to be transitory. But I'm going to ask you this question again. We've asked it several times. Really, how transitory is transitory? Could inflation, in your mind, perhaps be a little bit more durable than is currently believed?
Well, as you know, I've been harshly critical of the Fed on this particular account. I think they've got attention to deficit disorder and an inflation problem. I think they've lost the plot a long time ago. All we have to do is look to our wallets, Christian. I mean, my breakfast cost 60% more than it did a few years ago. Gasoline, education, medicine, anything that a regular consumer has to buy is already significantly pinching the wallet. So for the Fed to sit there and say, this is under control and we're not going to do anything, strikes me as incredibly arrogant and I think misguided.
All right. So then if you are, an investor right now and you're looking at some of these inflation moves, what right now is a really good inflation hedge?
Well, I think there's a couple. And again, it comes down to perspective, right? So you have to look at, number one, products that are being used in your life every single day, products that can protect margins every single day. And that means they have pricing power. So big tech is at the very top of the heap because no matter what happens with inflation, people are going to use it and or buy it more. So this is companies like Apple and Microsoft and even Amazon, which is getting hit to some extent today. This is not companies that are at the other end of the spectrum that are single source technology or recovery plays. If you look at medicine, if you look at insurance, if you look at those kinds of things that we have to have, that's where you protect against inflation.
I want to, ask you about some of the volatility that we've seen this month. I think it was 2 weeks ago now that we saw that huge sell-off on a Monday. I'm curious to know if you think that some of this volatility that we have been seeing in equities lately is going to continue throughout the rest of the year.
I do. I expect that to be a constant traveling companion. But again, if you're an investor, remember this: buy low, sell high is how the game's played. It's scary. It doesn't feel good, but history shows beyond any shadow of a doubt that big sell-offs are actually something you should like. You wouldn't go to a store with a 50% more sale, but you'd go to a store with a 50% less sale. Same with the stock market.
And I want to talk to you about earnings because so far it has been incredibly strong. Now, of course, we did see a disappointment from Amazon, but the other big tech names, of course, did not at all disappoint, absolutely having blowout quarters. Frankly, I don't even know if the word blowout is really a good enough description for what we saw from some of those other big tech names. I'm curious to know, however, just generally from the earnings season that we've seen so far, which again has been so strong, have we hit that peak earnings growth?
That's a tough call because the executives obviously know their businesses better than anybody. I think we probably may have hit peak earnings for this year. But if you look out 2, 3, 4, 5 years from now, I don't think we're anywhere close. So the question is not one of price. The question is one of value.
So then on tech, Keith, you were talking about them just a moment ago, but let's just again drill down into it. How are you liking some of those tech names right now? They did not lead the market in the first half of the year the way that we saw them last year in 2020. But what are you expecting from them as we go into 2022?
Well, I think let's start with Amazon, for example. That's at the top of everybody's mind today. It got absolutely clobbered in the after hours and is still struggling to catch a bid. But you know what? The company hasn't even begun to touch personal health and finance, and that's not reflected in the stock market. Angry regulators want to break it up. Okay, cool. That'll unlock some value. And then finally, I don't think the company has yet to recognize its full potential. And if there's a split, that's going to be great for the stock. I have to imagine the newly seated CEO, Andy Jassy, is thinking about that. Apple and Microsoft, relatively straightforward. Probably 90% of the planet uses one or both products from companies somewhere, at least changing gently in their lives. So that's a must-have in my book. And that's where my head's at. Big, liquid names you know well and can trust.
And we know how much millennial investors love their stock splits. And speaking of the millennial generation and Gen Z, I have to talk to you about Robinhood. Robinhood right now up almost 4% in today's trading session. Still, however, sitting below its IPO price. It opened at 38, so flat with its opening price. It's right now sitting just above $36 a share. Right there, you can see 36.17. What do you make of yesterday's IPO? We definitely saw Robinhood stumbling right out of the starting gate. I know you're not necessarily bullish on Robinhood, so please give us the criticisms, Keith.
Well, again, whether I'm bullish or bearish is irrelevant. I try to be fair. To me, this is one of the worst IPO rollouts I have ever seen, and I've been doing this 40 years, so I've got a little bit of time in the market that gives me some perspective anyway. I think that the company is noble in its intentions, but misguided in its execution. So, I think, and I called it yesterday, a bug in search of a windshield, that commentary is probably going to stand. I don't think it's going to end very well unless the executives start taking the trust that their customers place in them far more seriously.
Yeah, we definitely have heard a lot of folks, you're not alone here, in saying that Robinhood really is playing fast and loose with a lot of its customers' money, and a lot of the investors that are in Robinhood right now honestly could probably be better off at a Vegas casino. Keith Fitz-Gerald, Chief Investment Officer, Fitz-Gerald Group, thanks so much for joining us today.